All right, today we're diving into a really fascinating case study, ACHR Aviation, ticker ACHR. And what's so interesting here is that the technical data is basically in a fight with itself. You've got these incredibly strong signals saying, buy, 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 but then you've got these other signals flashing some major warning signs. So what's the real story? Let's dig in and find out.
So let's start with a number, a huge number, 160,904,327. What is that? That's the number of shares of ACHR Aviation that changed hands on just one day, October 6th. I mean, that is an absolutely insane amount of trading volume. And that massive surge of interest is really where our story begins.
And of course, that kind of interest doesn't just pop up out of thin air, right? If you look back over the last 3 months, you can see this incredible climb. We're talking from around $10.50 in July all the way up past $13.60 by October. You can even see these huge spikes in trading volume along the way. But here's the thing. The price alone, well, it only tells you half of what's going on. The really juicy part is in the technical data, and that's where things get complicated. So this is the core conflict, the central puzzle we're going to try to solve today. It's like the data has a split personality. You've got these powerful bullish signals that are just screaming that this rocket is still going up. But then you've got these really serious cautionary warnings that kind of make you think it's about to sputter out and fall back to Earth. It's a classic clash.
Okay, so first up, let's look at the bull case. Why are so many people excited about this stock? What's the argument for it going even higher?
Now, to really get this, we have to talk about a fundamental tool for traders, moving averages. If you're not familiar, don't worry, it's pretty simple. A stock's price can jump all over the place day to day, right? A moving average just smooths out all that noise so you can see the real underlying trend. It's like taking a bumpy road and paving it over so you can see which direction you're actually headed.
And check this out. This is textbook bullish stuff. The current price at $13.64 isn't just a little bit above its moving averages, it's way above all of them. The 5-day, the 10-day, even the long-term 200-day. What this tells you in plain English is that the stock is blowing its own recent and long-term performance out of the water. That is a huge sign of powerful upward momentum.
But wait, there's more. It's not just the moving averages. It's like a whole chorus of other technical indicators are all singing the same tune. You've got the MACD, which is a big one for momentum, showing that the buying pressure is actually getting stronger. Then there's the Arun oscillator, which is basically at max level, confirming this trend is unbelievably strong. And the Chaikin oscillator, it suggests the big money, the institutional investors, are pouring in. It's just one green light after another.
So looking at all that, you'd think this is a total no-brainer, right? A complete slam dunk. But this is exactly where the plot thickens. Because whenever you see a stock shoot up this fast, this high, you've got to ask yourself the big question. Is this thing flying too close to the sun? Can it possibly last?
All right, let's flip the coin and look at the other side of the story. This is the dose of caution, the argument that this thing might be seriously overbought.
So, what does overbought even mean? Well, that car engine analogy is perfect. Think about flooring it in your car. The engine is screaming, you're going super fast, you're at peak performance, but you know you can't keep that up forever. Eventually, you're going to have to ease off the gas or the engine will blow. An overbought stock is exactly like that. It's in the red zone and it might be due for a cooldown.
And the main way traders measure this is with something called the Relative Strength Index, or RSI. The general rule of thumb is that anything over 70 is considered overbought. Well, look at ACHR's RSI. It's not just over 70, it's at 81.48. That's not just knocking on the door of the danger zone, it's kicked the door down and is having a party inside.
And here it is, the conflict in a nutshell. You have the MACD on one shoulder telling you, go, go, go. The momentum is getting stronger. And then you have the RSI on the other shoulder yelling, stop, slow down, we are way overextended. They're giving you completely opposite advice. And you know, eventually, one of them is going to be proven right.
And it's not just the RSI waving a red flag. The price has actually punched through its upper Bollinger Band. Think of those bands like statistical guardrails on a highway, and the stock has just swerved into the shoulder. That's another classic sign of being overstretched. But maybe the most telling thing is the linear regression. That's a fancy way of saying the statistical line of best fit. And that line predicts a price of just over $9. The current price is over 13. That is a massive difference between where the stock is and where the underlying trend says it should be.
Okay, so
We've got the bulls and the bears in an all-out war, with the data to back up both sides. So what do you do with that? How do you make sense of it? Let's break down the 3 most likely ways this could play out.
Basically, you've got 3 potential paths from here. Path 1 is the bullish scenario. The good times keep rolling, momentum wins, and the price pushes even higher. Path 2 is the bearish scenario. The overbought warnings are spot on, gravity takes over, and the price pulls back to find a more stable level. And then there's path 3, the neutral one, where the 2 sides just slug it out and the stock bounces around in a range for a while. So, given all this, what's the final takeaway from this analysis? Well, the source suggests a cautious approach. Now remember, this isn't financial advice, but it's an interpretation of the conflicting signals. The conclusion is, with the stock so clearly in overbought territory, it might be a moment to consider taking some profits off the table if you're already in, or maybe just waiting on the sidelines for a pullback before jumping in fresh.
And you know, this whole thing really brings up a fascinating question about technical analysis itself. When you have charts and indicators, all based on math, that are telling you completely opposite things, what does that mean? It really makes you think, doesn't it? Maybe technical analysis isn't so much a hard science that gives you one right answer, but more of an art. The art of reading the tea leaves, weighing the odds, and ultimately managing risk in a world of uncertainty. It's definitely something to chew on.